Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we looked at the difficulty of overcoming trading losses to further emphasize the importance of protecting one's trading capital as a key component in any successful trading strategy. In today's lesson we're going to begin to build a strategy for money management with a look at one of the first components of this, setting your initial stop. As we learned about in my lesson on the effect of trading losses, many successful trading strategies have a success rate of less than 50%. With this in mind, these strategies and these traders are successful not because of their high rate of accuracy on an individual trade basis, but because of their ability to recognize when they're wrong and cut their losses, and on the flip side of that, to recognize when they're right and let their profits run. While the strategy you end up or you're trading now may have a success rate of higher than 50%, any strategy is going to have losing trades. So one of the first keys to staying in the game is having a plan for what you're going to do and how you're going to exit the market if the market does move against you. With this in mind, where most traders will start when developing their money management strategy is by determining how much money they're willing to risk on a per trade basis. While this is going to vary from strategy to strategy and from trader to trader, as Dr. Alexander Elder points out in his book, Trading for a Living, many studies have been done which show that traders who risk more than 2% of their account balance on any one trade are rarely successful over the long term. In addition to this, I can tell you from my experience watching many traders trade, the fact that most traders do risk more than 2% of their account balance is another contributing factor to the high failure rate among traders. So traders who set their per risk trade level at 2% or less not only decrease their chances of being knocked out of the market because they can sustain themselves through a fairly lengthy string of losses, but also put themselves in a situation where one trade is not going to make or break them. This is not only important from a money management standpoint, but it's also important from a psychological standpoint because it puts the trader in a position where they're not overly attached to any one trade. In order to have a true understanding of what this number should be for a specific strategy, you really need to have an understanding of what the expected accuracy rate is for that strategy. Something which we're going to cover in later lessons. For now, however, it's simply important to understand that the first step in designing any successful money management strategy is to determine what your risk level is on a per trade basis in relation to your overall account balance. Okay? So now that we have an understanding of this, we can move on to some specific strategies for setting stops which fit within this initial guideline, okay, which we're going to cover in tomorrow's lesson, or starting to cover in tomorrow's lesson, all right? So that's our lesson for today. As always, if you have any questions or comments, please feel free to leave them in the comments section below, and good luck with your trading.